Tesla shares are feeling the heat today after the car maker warned of potentially more pressure on its profitability. Earlier, we heard from two opposing analysts for their thoughts.
A confirmation that the business is just not as good as people want to believe, and not nearly as good as what you have to believe to justify the current stock price. At these super elevated levels, the stock's implying that this business is going to be the most profitable car company of all time by multiple factors, and own like upwards of 50 to 60% market share in 10 years. So I think that, as we see this business start to sort of, in this story, start to fray along the edges, more and more people are going to be skeptical of the extreme amount of risk you take in owning the stock anywhere close to these levels.
Well, how do you respond to that the risks are not adequately factored into how the stock is trading?
Well, I think if you want to look at it in a silo as a car company, then it's easy to make that argument. But what Elon continues to do in these quarterly calls is point out ancillary revenue and the fact that they're just not a car company. If you want to judge them by the same metrics as traditional car companies have been judged over the last 50 years, how many did they produce, how many did they deliver, that's not the game he's playing. The game he's playing is, how do I drive adoption here? How do I get these cars on the road at whatever cost? So that when the self-driving technology comes out, I can become the Uber of the world. So that when charging infrastructure is built, I can become the Shell oil company and the Mobil oil company, gas station businesses of the world. Talk about subscription revenue. Nobody talks about subscription revenue when you talk to Ford and GM. When you listen to Elon talk, he talks about the fact that these are computers on wheels that have subscriptions, and that's recurring revenue that will continue in perpetuity. So there was a day when people said that they couldn't justify Amazon stock because of their book sales, and those people that sold Amazon are still crying.
Will, I want to underline the point that you're saying. If you think Tesla is a car company, this is not the stock for you.
Tesla's not a car company. One line of Tesla's business is cars, so that people are attracted to the sexy Model X and want to drive it. But what they're really doing is Trojan horsing in EV battery adoption. And what they're really doing is driving adoption of a platform that will require subscription, that will require charging, that will require engagement. People buy Ford F-150s and don't re-engage with Ford and don't give revenue to Ford until they break down, which is an awful long time. People buy Teslas and pay them monthly in perpetuity to engage with the Tesla. It's a totally different business model.
David, I want you to pick up on that point, because one of the key reasons that you are bearish is because of competition from other car makers. And so if the thought is from Will that you shouldn't even be comparing them, that it's apples and orange, how does that complicate your thinking?
It doesn't really. Look, even if first of all, 87% of revenue currently comes from the automobile business. But even if we assume that ancillary businesses, which have yet to really even be proven profitable, even if we assume that they can account for 40% of the revenue, let's say 10 years from now, you're still looking at revenue for the auto division that implies something like 60 to 80% market share in terms of vehicle sales. So, even if you give them 40%, and by the way, across all these businesses, we're assuming that returns on the capital get over 100%. Or we're not assuming, the market price is assuming. And then when it comes to subscriptions, look, all of these EV vehicles are going to be computers on wheels. So that's not something that's unique to Tesla. All of the other providers, and there's a lot of them, can do the same thing. And then when it comes to full self-driving, I'm surprised. I think, look, everyone would love, Will, for full self-driving to actually work. But when you look at where Tesla ranks compared to the other firms out there that are trying to build the same thing, they've moved to the bottom of the pack. So I wouldn't place a lot of value on full self-driving for Tesla. It's a long way off. And look, if it really works, who needs their own car anyway, right? So This idea that full self-driving and all these ancillary businesses are going to somehow come in and save the day, it's more than priced into the stock already, and it's still really risky, even if you believe in those things.
I want to, I guess, drive home the magnitude to which you are bearish. Your price target is $26, or the point at which you think Tesla is fairly valued. It's currently trading at $270. That seems like a lot of downside until you realize that before the pandemic, this is basically where the stock traded, that a lot of these gains had come kind of during the pandemic for Tesla. How do you get all the way back down to $26?
Yeah, we still assume that the business has quite a bit of profit growth at a $26 stock price. In fact, we get them to achieving 1.7 trillion in revenue in 2023, and that results in 1.5 trillion in auto revenue, and that's still 31 million vehicles at an ASP of $47,000, or about 30 million vehicles at a $49,000 ASP, or 52 million vehicles at a $28,000 ESP, which is the average new car price across the world. So we think that's still really expensive. Toyota, the world's largest automaker today, did 10.5 million vehicles in 2022 and is expected to do 10.4 million in 2023. So even at $26 a share, and even assuming that ancillary businesses can take over 40% of the business, you're looking at implied vehicle production that is still really, really impressive. And so, the valuation here has been disconnected from fundamentals. Anybody doing the homework with a reverse discounted cash flow model, or return on invested capital, or even free cash flow, it's easy to see that the risk here, especially given the run-up, the risk here is just not worth the potential reward.
$26, well, what's your view on the other side?
I certainly wouldn't put my kids' college tuition into a Tesla short right now. I don't disagree with everything that he said, but I will point out that, those are traditional metrics, and those aren't the metrics that Tesla measures themselves to. And this business, I agree, it'll be a long time until this business fits into a backward-looking model, and this business looks good against traditional car companies, but that's not the business they're in.
That was Will McDonough, founder and lead portfolio manager at EMG Advisors, and David Traynor, founder and CEO at New Constructs.